This is Global Signals by Andrew Dremin, deep dives and insights about retail and FMCG. By the year 2050, the demographic map of where humans live is going to look entirely different. This demographic projection chart shows exactly where that density is heading. Dhaka is expected to surge past 52 million residents, and Jakarta will follow closely behind at nearly 50 million. If we extend this timeline out to this chart showing 2100, the data reveals that the 15 largest cities on Earth will be located entirely across Asia and Africa. Retail executives often look at these demographic models and assume that explosive population growth guarantees consumer goods revenue. But headcount is not profit. The sheer physical scale of these emerging megacities is overwhelming. The density is absolute. If your plan is to expand a consumer packaged goods brand into these regions based purely on population tables, you risk burning your capital entirely. There is a severe drop-off between sheer population size and actual purchasing power. A market of 50 million people looks great on a pitch slide, but building a viable business there requires looking past top-line volume metrics. Executives must completely reevaluate their unit economics, their margin retention, and their operating overhead to survive in these environments. In low-income urban clusters, the majority of the population does not buy family-sized cereal boxes or 500-milliliter shampoo bottles. We can see the danger clearly in this strategic retail matrix. When high headcount meets low purchasing power, brands fall directly into a high-volume, low-gross margin trap. This creates the sachet unit economics problem. The daily reality here is the purchase of single-serve micropacks, usually priced between 5 and 15 cents. When an item retails for 10 cents, gross profit is measured in microscopic fractions of a cent. You must manufacture, pack, and move millions of units monthly just to pay overhead, locking up substantial working capital. This leads to a paradox in absolute dollar returns. A mature European market might look unappealing because the annual population growth is flat. But a 0.2% market share in Germany or the UK will often deliver higher absolute cash flow and gross profit than a 10% market share in a highly volatile megacity. The financial pressure compounds when we look at distribution. Western logistics models rely on semi-trucks, palletized shipments, and centralized distribution hubs supplying organized supermarkets. This retail channel table shows exactly why that system fails in dense urban zones. Reaching 1 million people in a developed market requires supplying 10 to 30 hypermarkets. In an emerging megacity, that exact same population is served by 5,000 to 15,000 corner kiosks. This traditional trade dominates the landscape. Up to 80% of retail sales run through roadside kiosks like this Indonesian Warung or Bangladeshi Mudir Dokans. Delivering across unmapped, dense urban gridlock means these thousands of kiosks have to be supplied by vast fleets of motorcycles and handcarts. Every time a product changes hands, it costs you money. These extra layers of micro-distributors drain the distribution margins drastically, leaving a net margin of maybe 2 to 4%. At 2%, there is zero room for operational error. Porting a Western logistics strategy directly into traditional trade guarantees structural failure. The product itself carries a severe manufacturing flaw. Foil laminates, multi-layer plastics, and seals required for single-serve sachets carry a disproportionately high packaging-to-product cost ratio. Local governments facing waste crises are passing severe plastic bans. Brands must switch to expensive biodegradable materials or pay heavy municipal waste fines. Then you have the competition. International brands consistently underestimate deeply entrenched domestic conglomerates who control the local supply chain. Local operators run extremely low-cost operational bases and readily accept the single-digit net margins that a Western public corporation simply cannot justify to its shareholders. They also maintain unmatched local kiosk loyalty. Local field reps visit these independent mom-and-pop shops every single week. They extend informal credit and resolve inventory issues right on the spot, building a defensive moat that foreign competitors struggle to cross. This combination of supply control, extreme margin tolerance, and grassroots agility makes domestic players formidable opponents. If you survive the logistics and the local competition, you still face a critical currency mismatch. This is the FX trap. A consumer goods business generates its cash in local currency, like taka or rupiah. but the factory equipment, spare parts, and active ingredients have to be bought in US dollars or euros. A sudden 15 to 25% currency devaluation instantly wipes out whatever thin operating margin you had left. And you cannot raise a retail sachet price from 10 cents to 13 cents without entirely losing your price-sensitive shoppers to local alternatives. Finally, there is the counterparty risk of selling into thousands of independent micro-retailers. Because kiosks operate on minimal working capital, distributors often must front goods on informal credit lines just to get them on the shelf. When macroeconomic conditions slow down, recovering receivables from 10,000 undocumented micro shops becomes impossible. The result is catastrophic bad debt and inventory write-offs. To build a viable business here and avoid these traps, brands must adopt one of 3 specific entry strategies. This document outlines 3 options. Strategy 1 is domestic contract manufacturing, which avoids import tariffs and mitigates exchange rate risks. Strategy 2 is local joint ventures, where a local partner handles route-to-market logistics. Strategy 3 is acquiring established domestic brands for instant manufacturing infrastructure. Optimizing an existing production line is a safer financial bet than trying to build brand infrastructure from zero in a complex environment. Relying on standard export tactics and building large, Western-style hypermarkets will not deliver long-term returns in high-density growth markets. Success requires looking past the massive demographic headcounts and mastering the brutal unit economics of the traditional trade network. You were watching Global Signals by Dremin, deep dives and insights about retail and FMCG.